Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready to get into another really fascinating company.
This is one I've been excited to talk about for a while.
Today, we're breaking down one of the most enigmatic, most powerful, and, let's be honest, least accessible companies in the entire global technology sector. Constellation Software, or CSU.
Yeah, for decades, this thing has been the ultimate black box of enterprise software. It's just been quietly accumulating hundreds and hundreds of these niche businesses, compounding capital at an absolutely astonishing rate.
And doing it all, completely outside the glare of the usual market hype and media attention.
And that silent compounding is exactly why this deep dive is so timely. On the surface, it's this amazing business with, a brand that's basically invisible to the average person.
Yeah.
But the real question for us as long-term investors is this. The stock has just had a major pullback. We're talking about 30% off its peak. Is this a rare, once-in-a-decade entry point into an elite compounder? Or are the cracks from the law of large numbers finally starting to show in the fortress?
That's a huge topic. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now, let's get into it. Let's unpack this valuation right away and just get the hard snapshot data out there.
Good idea. So for context, we're looking at a current price point hovering around, CAD 2,922?
Yeah, roughly there. And that supports a massive market cap of about 62 billion Canadian dollars. I mean, that size alone makes you pause, doesn't it?
It absolutely does. But here is the key signal, the thing that makes this recent drawdown so compelling. It's the free cash flow yield.
Okay, tell me about that.
For a growth compounder, a business that's supposed to be perpetually reinvesting, to see a free cash flow yield between 4.1 and 5.5% is, it's highly unusual.
It's very attractive, frankly.
It's very attractive. That 30% decline we saw wasn't just, market volatility.
Right.
It feels like it stripped away the speculative froth and moved the stock into a zone that really demands the attention of disciplined long-term investors.
Because if you just stop at the headlines, the stock still looks structurally very expensive.
It does. It trades at about 65 times trailing 12-month earnings and around 25, 26 times enterprise value to EBITDA. That just screams overvalued perfection.
It really does.
But that trailing data is, I think, really deceiving because of their whole business model, the high return acquisition strategy. When you look at the forward estimates, that PE ratio is already compressing and fast. It's dropping down to around 38 times.
Okay, so that's a big difference.
It's a huge difference. And that compression suggests that the market expects future earnings growth to catch up very quickly. It's a repricing of the future growth trajectory, not necessarily the current quality.
So our mission today is really to understand the quality of that earnings conversion, the surprising durability of these little businesses they own, and the elite discipline of their capital allocation engine.
Exactly.
Let's start right at the foundation then, because without a really solid grasp of the business engine, the whole capital allocation strategy that follows just makes no sense.
Right.
When people hear tech company, they think of, giants selling generic cloud platforms, a Salesforce and Amazon Web Services. But the black box of Constellation is fundamentally different. It's all built on buying and running something called vertical market software, or VMS.
Yeah, and they own over 1,000 of these distinct, really niche software firms.
So for you listening, what exactly makes these VMS assets so compelling? Can you give us some of those concrete examples that make this super relatable?
The genius of VMS is in its extreme granularity, its specialization. These are not, general purpose tools like Microsoft Office.
Yeah.
They are precision instruments designed for these hyper-specific workflows inside tiny market segments. Let's use those examples. Think about the bespoke scheduling and routing software that a public transit authority in, say, a mid-sized city in Iowa would need.
Okay.
That system has to handle real-time fleet management, driver schedules, compliance with union rules, integration with ticketing systems. It's incredibly complex.
And completely unique to that one use case.
Totally. Or think about the software needed to manage a network of marinas in Florida.
Yeah.
It's everything from boat slip bookings and fuel inventory to complex winterizing schedules and, all the regulatory tracking that goes with it.
These markets are small. They're not glamorous at all.
No, but the software is absolutely mission critical. They are the systems of record. They literally run the client's day-to-day operations. If that software fails, it would be an operational catastrophe.
So the immediate unit economic implication of that hyper specificity,
hmm
what is it? Does it just create stickiness, or are we talking about a true lock-in effect for Constellation?
We're talking about a tremendous lock-in effect, which translates directly into structural stickiness and unbelievably low churn.
Okay.
Let's just look at it from the customer's cost perspective for a second. The annual maintenance fee or, the subscription for that transit software might be 50, maybe $100,000.
Which sounds like a lot of money.
It does, but think about the operational exposure. If that system goes down, or if the authority tries to replace it and runs into scheduling errors or loses data or gets regulatory fines, the cost of that disruption could easily be in the millions.
So the software cost is a rounding error.
It's a fraction, often less than 1% of the customer's overall operating budget. It is cheap, mission-critical insurance. And as a result, these VMS businesses that CSU acquires are essentially annuity-like revenue streams. They have highly predictable, recession-resistant cash flows.
And this brings us to pricing power, which is where it gets really, really interesting, because we're not just talking about passively waiting for low churn to generate cash. We're talking about aggressively taking advantage of the structural scarcity in these markets.
That's absolutely right. They have classic structural pricing power, which is, the hallmark of any great business. Because these VMS segments are so niche, they often only have one or two serious competitors, sometimes none.
Right.
So CSU can proactively raise those maintenance and support fees every single year, and critically, they can raise them above the rate of inflation. They routinely target 5 to 7% increases without seeing customers leave.
And the customer just has to do that cost-benefit analysis in their head.
Exactly. The pain and the risk of paying a 6% annual price hike is trivial compared to the operational pain, the procedural risk, and all the training costs involved in switching to a new system. This pricing power ensures that the whole portfolio generates predictable organic growth, even if the number of customers stays completely flat.
Okay, let's talk moats. If those spectacular unit economics are the building blocks, what protects the fortress from challengers? There seem to be two primary moats. Let's start with the big one, the one protecting the asset itself, switching costs.
The primary moat is absolutely rooted in switching costs, but we need to be really specific here. This is driven by procedural switching costs, not just, the hassle of data migration.
That's a crucial distinction.
It is. Ripping out a deeply embedded mission-critical system like one managing bus routes or municipal water systems involves massive behavioral, political, and operational inertia.
So what does that mean in practice?
Well, think about the internal political cost for the CIO or the municipal manager who champions a new system only to have it fail during the migration. You could lose years of historical data or cause a massive public disruption.
It's career suicide.
It's absolute career suicide. And on top of that, you have thousands of employees who are trained on the existing system. Changing it requires massive retraining, process reengineering, and the nightmare of mapping old data structures onto new ones. This procedural risk is the real wall.
So what's the measurable, tangible result of that procedural switching cost moat? What numbers do we see?
The outcome is phenomenal. We see typical retention rates across the entire VMS portfolio consistently exceeding 95%.
95%.
Sometimes it's even higher. Think about that for a moment. You are effectively owning a perpetual annuity stream of maintenance revenue that, thanks to those inflation-beating price increases, grows automatically. And it almost never walks out the door. That is the core flywheel. That's what generates the prodigious and predictable free cash flow that funds the entire acquisition machine.
So the assets themselves are incredibly sticky, protected by all this behavioral friction. That protects the revenue stream. But if anyone can just go out and buy these same types of niche assets, the moat is incomplete. So let's shift to the secondary moat, the defense mechanism that protects their ability to acquire these assets at high returns. This is what we're calling process power.
Process power is arguably the most valuable yet most underrated asset Constellation possesses. It is the proprietary M&A engine itself.
Right.
Most large companies, they centralize their M&A. Decisions are made at the top, which leads to internal bottlenecks and slow execution. CSU, conversely, has pushed capital deployment way down to thousands of decentralized unit managers.
So they're empowering these managers on the ground.
They're empowering them to deploy small checks, often in the $5 to $10 million range, sometimes a bit larger, as long as they stick to one sacred principle: the hurdle rate discipline.
Okay, stop there. The hurdle rate, we've mentioned it, but it's essential jargon. What exactly is the hurdle rate, and why is that discipline so critical to this process power mode?
The hurdle rate is the minimum required internal rate of return, or IRR, that any potential acquisition has to meet to get approved. For CSU's smaller deals, this rate is extremely high. We're typically talking a target between 20 and 30%.
Wow.
And this acts as a really powerful internal quality control mechanism. By decentralizing the power to deploy the capital, but centralizing this rigid financial standard, the hurdle rate, they ensure that the entire machine is constantly prioritizing super high return projects.
And competitors just can't do this.
Competitors, especially the big private equity firms, really struggle to efficiently manage the transaction costs and due diligence required to write thousands of checks that small while maintaining that high of a hurdle rate. They get bogged down in centralized bureaucracy, or they're just forced into larger, lower return deals.
So the secondary moat isn't proprietary code or some kind of financial engineering. It's a proprietary, decentralized behavior at massive scale. They've perfected the art of the tiny, high ROIC deal, and nobody else can efficiently replicate that structure.
Exactly. It's an organizational competitive advantage built on culture and discipline. It's about how they find, vet, integrate, and then run these micro-businesses under an umbrella of extreme autonomy and financial rigor. And this scalability and discipline in M&A, that itself becomes a deep moat. It allows them to maintain industry-leading returns, even as their overall capital base swells to billions and billions of dollars.
Which leads us perfectly into their culture.
The robust financial and operational strength we just detailed is only possible because of a cultural architecture that is really unique in the modern corporate landscape. We can analyze this through the Lollapalooza effect, the convergence of multiple powerful behavioral and financial forces.
Yeah.
Here, it's the convergence of extreme decentralization, which fights bureaucracy, and profound incentive alignment, which drives a real ownership mentality.
On this extreme decentralization, it feels like their deliberate antidote to what you could call the institutional imperative, that natural tendency for massive companies to become slow, centralized, and self-serving.
That's a great way to put it. They consciously avoid the headquarters bottleneck. They don't try to integrate every VMS firm's HR or sales or IT functions for some kind of artificial synergy.
They just let them run themselves.
They let the VMS businesses run themselves, often with the original founders still in charge. The only thing that's centralized and tightly monitored is capital allocation.
That's the key.
And that organizational choice, when you pair it with their truly unique incentive alignment, ensures that managers don't just become complacent employees. They remain owners.
So let's talk about how that culture gives them a sourcing advantage, which then directly impacts their returns. This anti-fragile culture, why does it let them win deals against competitors, even when they aren't the highest bidder?
This founder-friendly reputation is a monumental competitive edge, particularly against private equity. When a PE firm buys an asset, the founder knows there's usually a 5-year flip horizon.
We're at slash and burn.
Yeah, often involving heavy cost-cutting, loading it up with debt, and management changes, all aimed at maximizing a quick exit. CSU offers perpetual ownership. They effectively promise the founder, "We are not going to merge your business into some massive, faceless entity. We will not fire your loyal team. You get to keep running your baby."
That's a powerful emotional appeal.
It resonates so deeply with founders who often see their software company as their life's legacy, not just an asset to be stripped. And this unique promise acts as powerful counterpositioning against the standard PE model.
The fascinating and quantifiable outcome here is that founders will frequently choose to sell to CSU for a lower price. They'll accept a founder-friendly discount than what they might get from a debt-fueled PE buyer, just to protect that legacy in their employees.
It's significant enough to materially affect the returns. While it varies, reliable analysis suggests this discount can translate to an acquisition multiple reduction of between 1 and 2 times cash flow multiples, especially on the smaller deals.
So if a PE firm needs to pay 8 by EBITDA,
CSU might win that deal at 6.5x or 7x. And that immediate reduction in the purchase price drastically improves the internal rate of return for CSU on that specific investment. It just reinforces the high ROIC we're about to discuss.
Okay, now we get to the critical detail that really defines their quality of earnings. The SBC reality check. This is the gold standard for shareholder alignment, and it's where we need to introduce some friction. Why isn't Constellation just doing what every other tech company does?
This is the single biggest separation point from all the high-flying tech peers.
Hmm.
CSU has effectively 0% stock-based compensation, or SBC, as a form of compensation for its employees and management.
Zero.
Zero. It's almost unheard of in the modern growth-focused tech sector, where options and restricted stock units are just the default currency.
But wait, isn't requiring managers to buy stock and lock it up a pretty significant deterrent in a hot labor market? How does CSU retain top talent if they aren't offering the instant gratification of free options that, a FA company offers?
That's the essential challenge, and the answer really lies in the philosophical commitment and the quality of talent they're looking for. They're not trying to attract short-term stock traders. They're looking for long-term owners and operators.
So how does the mechanism actually work?
It works like this. Management and employees get cash bonuses based on their performance bonuses paid out of the pure cash flow generated by their units. They are then required to use a significant portion of that cash to purchase CSU shares on the open market.
At the market price? With their own money?
At the market price. And crucially, those shares are then locked up for a period of 3 to 5 years. This aligns incentives absolutely perfectly. Managers are buying the stock just like you would. They feel the pain if the stock declines, and they benefit as true owners, all without diluting existing shareholders.
And the SBC is zero because the cash outflow is recognized as compensation, and the share purchase is a voluntary, though highly incentivized investment.
Yeah.
So let's make this crystal clear for you, the listener, especially when you're comparing CSU to its peers. What does this zero SBC policy mean when we analyze free cash flow?
The implication is massive, and it defines the purity of their earnings. Let's just use a hypothetical comparison. When you look at many high-flying software companies, a Salesforce, a ServiceNow, they report robust free cash flow.
They do.
But that FCF figure is calculated by adding back the non-cash SBC expense to net income. That SBC often inflates their reported FCF by anywhere from 20 to 30%.
So in real terms, that cash expense exists, it's just paid in dilutive stock. The FCF they report isn't truly cash available for deployment.
Exactly. If a peer reports $100 million in FCF, maybe $25 million of that is actually SBC dilution. CSU's FCF is pristine. Their free cash flow conversion ratio is consistently above 100% of net income because their FCF is truly cash generated and immediately available for deployment, unburdened by any of that hidden shareholder dilution. You are buying real deployable dollars, not accounting artifacts.
And that structural purity of earnings is directly reflected in the key performance indicator of any capital allocator, return on invested capital, or ROIC. This is the CEO's report card.
The ROIC analysis is the ultimate confirmation of CSU's elite status as a compounder. They consistently generate returns between 16 and 25% on invested capital.
And when you compare that to their cost of capital?
When you compare that to their weighted average cost of capital, or WACC, which sits conservatively around 6 to 7%, you see this truly remarkable spread of over 10 percentage points.
And that spread is the engine of compounding wealth.
It's the whole engine. It proves that every single dollar they deploy, whether it's sourced from retained earnings or external capital, generates substantially more than it costs.
What's truly remarkable, given the massive $60 billion capital base we discussed, is that this ROIC has remained so resilient. Most capital allocators see the returns degrade over time because they just have more money to deploy and are forced into lower quality, larger, or more competitive deals.
Right.
How has CSU managed to maintain such a high ROIC despite that swelling capital base?
They've managed it by religiously adhering to two principles. First, the commitment to the small deal strategy, those high-margin $5 to $10 million checks with the founder-friendly discount. That remains the core focus.
And
Second, organizational design. They have continually broken up the company into smaller, more autonomous units, preventing the organizational fatigue that leads to lower returns. They actively resist the temptation of chasing large, transformative deals purely for ego.
This dedication to discipline is best seen in their cash deployment hierarchy, which is basically non-negotiable and rigorously enforced by their leadership, particularly the founder, Mark Leonard.
That's such an important point on the leadership. Leonard is often called an outsider CEO, a reference to the archetypes defined by William Thorndike leaders, whose primary focus is rational capital allocation, not just growing the size of their empire or satisfying short-term investor demands.
So what does his hierarchy dictate?
It dictates the flow of cash. Priority 1 is acquisitions. They redeploy virtually 100% of their annual free cash flow immediately back into M&A. If they generate cash, the internal machine is geared toward finding a high IRR VMS target to buy.
Okay, what about dividends and buybacks? In today's market, investors often demand capital returns.
Second priority is dividends. They pay a minimal dividend, historically around a 1% yield, but only when high IRR opportunities deals generating, say, 20+% internal rates of return are scarce. They are not interested in returning capital just to signal stability.
They want to reinvest every dollar in the highest possible rate.
Exactly. And third is buybacks. They haven't done any recently because the stock has typically traded above what the management team believes is its intrinsic value. The outsider approach means Leonard fundamentally refuses to buy back stock at a premium, even when the market is pressuring them to use cash to support the share price. They prioritize disciplined capital deployment over satisfying short-term shareholder expectations, period.
Now we have to confront the inevitable challenge of scale. Constellation Software is huge, it's deploying billions. We established that the growth engine relies entirely on inorganic volume, requiring them to deploy, $2 billion or more annually into 100+ small deals. The constraint can't be the VMS market itself, so what's the actual bottleneck to sustaining this high-speed growth?
You're right, the total addressable market, the TAM, is enormous. The VMS universe globally consists of tens of thousands of potential targets. Saturation is a long, long way off.
So what's the problem?
The immediate constraint is purely human capital. They need to find enough trained, high-quality capital allocators, the unit managers, who have the right mix of financial discipline, operational savvy, and cultural acumen to vet, close, and integrate these small deals while maintaining that sacred hurdle rate.
These people have to be operators, not just deal makers with egos.
Exactly. The growth bottleneck is talent acquisition and management training, specifically training managers to effectively screen and deploy capital in a decentralized way.
That seems like a really tough internal design challenge. So how are they fighting this law of large numbers and making sure they have a next leg of growth beyond just finding more $5 million deals?
They've developed some pretty sophisticated organizational methods to handle the ever-increasing flow of capital. First, they are tackling larger carve-out acquisitions.
Okay, what are those?
These involve purchasing non-core VMS assets from major corporations, like acquiring assets from large health IT firms like Allscripts. These deals are larger, and they're lower margin at first because they often come with legacy corporate baggage, but they provide a big volume bump for capital deployment.
And the second method?
Second, and maybe more importantly, they have pioneered the use of vertical spin-offs.
Explain the spin-offs, like Topicus and Lumen. That seems to be a structural solution to the whole too much capital problem.
It absolutely is. When the main balance sheet CSU becomes too heavy, the marginal returns on new investments start to risk dilution. So by spinning off large verticals like Topicus, which focuses on European VMS, or Lumen, which is communications and media VMS, they create a separate, publicly traded entity.
And this new entity gets a fresh, less burdened capital structure.
Exactly. Allowing it to continue running the exact same CSU playbook, targeting small, high IRR deals within its own vertical. And this strategy proves two things. One, the model is replicable, and two, it provides a crucial outlet for the continuous flow of capital generated by the parent company.
This all leads us to the valuation reset after that 30% drawdown. This is where it gets critical for you, the potential investor. What is the market actually wagering on right now? What growth rate is baked into the current price?
I think the market has become far more rational about its expectations. At 25 times EV to EBITDA and a 4% FCF yield, the market is demonstrably not pricing in the 20+% growth rates we saw during the peak software euphoria in prior years.
That speculative froth is gone.
It's gone. The current valuation implies the market is pricing in roughly 10 to 12% durable, compounding annual growth going forward. And this is incredibly significant because that 10 to 12% level of durable growth seems highly achievable, maybe even conservative, given the defensive nature of their VMS assets, their inflation-beating pricing power, and their continuous high-return reinvestment.
And the fact that the stock is now trading near its 5-year average FCF multiple also suggests that the excessive premium has been completely wrung out of the valuation. We're back to valuation multiples based on fundamental compounding expectations, not, AI or software hype.
That is the structural interpretation. And to give our analysis maximum conviction, we triangulated the intrinsic value using 3 separate methods. This gives you the full scope of the analysis, independent of the current day-to-day market sentiment.
All right, walk us through those three methods, starting with the simplest one, historical mean reversion.
Historical mean reversion suggests a conservative fair value target of around 4,100 CAD. This is calculated by applying a 35 times fair PE multiple to the estimated forward earnings per share of $117.
35 times earnings is still a significant premium.
It is, but it acknowledges the scarcity of a business with this quality and compounding ability. And it contrasts sharply with the 65 times trailing PE that scares off a superficial analysis.
Okay. Method number two is the consensus view. What's the street saying collectively?
Analyst consensus is more bullish. It averages around 4,860 CAD per share. This includes a really wide band of estimates, with low targets around 3,800 and high targets stretching all the way up to 5,600.
Why so bullish?
This high average reflects the street's acknowledgement of the structural advantages, the replicability of the model through the spin-offs, and just the sheer length of the reinvestment runway.
And finally, the method we generally prefer for a high-quality compounder with pure earnings, owner earnings or discounted free cash flow.
Using the owner earnings method, we start with the estimated current annual free cash flow of about $2.56 billion. We then assume a conservative 12% growth rate for the next 10 years, an assumption that aligns perfectly with the market's implied expectation, and we discount those future cash flows back at a required rate of return of 9%.
Why 9% for the discount rate? That seems a bit low.
We use 9% because a business of this stability, predictability, and elite management quality really warrants a lower required return than an average market stock. It reflects the lower perceived risk of capital loss and the high certainty of the cash flows. And when you run that DCF calculation, the fair value lands at approximately 3,600 CAD.
So the range of intrinsic value, derived from conservative financial modeling and analyst estimates, is sitting firmly between 3,600 and nearly 4,900 Canadian dollars. Based on that triangulated analysis, what's the final verdict on the current price of around 2,900?
The verdict is pretty clear. The price sits firmly within the designated margin of safety. We define the buy zone, the price range that offers a genuine margin of safety for an elite compounder, as CAD 2,800 to 3,050. At the current price, the market has truly done the heavy lifting for us. It's stripped away the speculation and is allowing a disciplined investor to acquire this elite capital allocator at a price that offers significant upside back toward its intrinsic value.
Okay, we have to run the rigorous challenge now, the pre-mortem. If this investment fails, we need to know what killed the thesis. Let's detail the two major risks that could unravel this long-term compounding story, starting with the biggest internal threat, the elephant constraint.
The biggest internal threat is the skill problem manifesting as ROIC degradation. As CSU continues to grow and needs to deploy $2 billion, $3 billion, and eventually more, it must execute larger deals just to move the needle on a $62 billion market cap.
Right.
The problem is cyclical. Larger deals face exponentially more competition, particularly from the private equity world. They're more likely to attract bidding wars, and they typically have structurally lower ROIC than the small, obscure deals CSU built its reputation on.
So the critical risk is that they are inevitably forced upmarket.
And their industry-leading ROIC, which currently sits around 25%, begins to trend downward and converges toward their cost of capital, let's say 10%.
And if the marginal return on invested capital drops that severely, what is the consequence for you, the shareholder?
The multiple collapses. If Constellation is no longer an elite capital allocator generating 18 to 25% returns on new acquisitions, it ceases to be valued like one, regardless of how stable the underlying VMS cash flows are. The market premium is paid for the reinvestment machine, not just the stability. The multiple would re-rate sharply downward, erasing years of market gains in a very short period of time.
The second major risk is cultural, and it's tied directly to that decentralized architecture. We have to discuss keyman risk, even though the founder, Mark Leonard, has stepped back, and the threat of cultural decay.
Mark Leonard remains the high priest of this culture, even in retirement. He designed the extreme decentralization, the hurdle rate discipline, and he enforced the zero SBC policy. The culture is the moat.
So if that erodes,
If that decentralized ethos erodes, if the new generation of leadership or even the unit managers fall victim to the institutional imperative, the entire machine is jeopardized.
define the institutional imperative for us here.
The institutional imperative is that corporate tendency to prioritize politics, bureaucracy, and just sheer size over profitability. It would mean they start centralizing functions they shouldn't, trying to force integration for artificial synergy, or worst of all, lowering the hurdle rate just to get deals done and keep the machine growing. If that happens, the essential process power vanishes. That cultural moat, which allows them to efficiently deploy capital, is incredibly fragile. It depends entirely on organizational vigilance and continuous strict adherence to the founder's ethos.
Okay, let's synthesize the core bear case thesis now.
Mhm.
What are the contrarians arguing? If you're a longtime skeptic of CSU, what is your primary argument for staying away?
The bear case really hinges on three connected ideas. First, the law of large numbers dictates that deploying over $2 billion in capital every single year at a consistent 20+% return is just, well, it's physically unsustainable indefinitely.
But that's fair.
Second, fierce private equity competition. Firms like Vista and Thoma Bravo are aggressively bidding up the price of high-quality VMS assets, which structurally compresses CSU's internal rate of return on any new deals. And third, multiple compression. If the growth structurally slows from the implied 12% down to, say, 7 or 8% due to that capital constraint, the stock multiple could easily re-rate from 25 times EV to EBITDA down to a more standard 18 times.
And if that happens?
If that happens, the stock would face a potential 50% downside, justifying the extreme caution of the bears.
This is where we bring in the red team challenge, the most provocative counter-argument, which essentially states that CSU's discipline is actually its fatal flaw in the current environment.
It is a truly compelling, if a little scary, argument. The red team argues, you are betting on a past correlation persisting in a new capital regime. Constellation is now simply too big to operate under its original rules.
So what's their point?
They assert that private equity firms haven't just copied the organizational playbook. They get the value of VMS. But crucially, they use a cheaper cost of capital because they load the acquisitions with debt, leveraging up the returns. CSU fundamentally refuses to use leverage aggressively. They prioritize financial purity and stability over maximum speed and size.
So introduce the friction point. In a bidding war for a quality VMS asset, the red team argues that the disciplined bidder Constellation Software, with its commitment to a 20+% IRR and zero leverage, loses the deal every single time to the debt-fueled bidder who can afford to pay a 1 or 2 times higher multiple.
That is the ultimate conclusion. The red team suggests that CSU faces a binary choice that will either kill their growth or kill their returns. Either they stop growing because they are constantly outbid for the best assets by leveraged rivals, or
they have to accept lower returns.
they have to accept lower returns by compromising on their sacred hurdle rate discipline, which would violate the entire cultural architecture. Their closing verdict is that at 65 times trailing earnings, you are paying for perfection in an environment that has become intensely hostile and competitively distorted due to the financial engineering capabilities of PE rivals.
Okay, let's bring it all together.
To synthesize everything we've covered in this deep dive, the fundamental quality score of Constellation Software is undeniably elite. This company has a unique combination of structural moats procedural switching costs and process power superior incentive alignment via zero SBC and a proven reinvestment runway.
And the valuation score.
The valuation score, thanks entirely to this recent pullback, is now fair to cheap. We are looking at a genuine margin of safety created by temporary market anxiety, not a structural failure in the business.
And the bull case thesis is robust because it really rests on durability, doesn't it? You're buying an elite compounder at a 4 to 5% free cash flow yield, which historically suggests long-term internal rates of return of 15% or more are highly achievable.
That's right. You are getting recession-proof, annuity-like cash flows, protected by inflation-beating pricing power, and run by a management team that has proven they can fight the law of large numbers through organizational innovation, like the Lumini and Topicus spinoffs.
So let's quickly recap the core insights that truly differentiate CSU for you, the disciplined investor.
The zero stock-based compensation ensures the FCF is pure and deployable, and that management is aligned with long-term ownership. The phenomenal high retention rates driven by those intricate procedural switching costs guarantee the durability of that annuity-like revenue base.
And the process power.
And the decentralized, disciplined M&A engine, the process power, is a rare competitive moat that prevents rivals from replicating their success at scale.
We've established that the current price sits in a defensible buy zone. But before we close this deep dive, let's leave you with a final provocative thought that builds directly on that red team challenge we just discussed.
The red team argued that CSU's refusal to use aggressive leverage means they will ultimately lose bidding wars for high-quality assets, potentially stifling their growth or forcing them to accept lower returns. This raises a monumental question for every investor who's weighing this opportunity.
Go on.
In a modern capital market dominated by financial engineering, where cheap debt-fueled capital is readily available to private equity rivals, can superior cultural discipline and pristine, low-leverage capital allocation always generate higher long-term returns? Is the process power and cultural purity of Constellation Software anti-fragile enough to continuously overcome the significant cost of capital advantage held by leveraged competitors? Or is extreme financial discipline ultimately a limiting factor in a growth-at-any-cost environment?
That is the ultimate trade-off you're weighing with this investment.
And a question worth spending a lot of time on as you conclude your own analysis.
A fantastic fundamental note to end on. Thank you for joining us for this deep dive into the Constellation Software compounder. We'll see you next time.